The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. Let's make some money. Let's see. Let me get my chart here. Okay, I'm sorry, y'all. Got this thing all whacked. All right. And here we go. All right. Okay, just to cut to the chase here, which is the S&P futures. I'm looking at the monthly chart view. Of course, we got, weak momentum and all that stuff, at the bottom here. Zoom in on these monthly candles because, seeing less candles is clearer. So we got a resistance area over here on the left where this was a key area where when we were on the way up, and we're struggling to get beyond that level. You see right here, 45, 49.4. We're looking right there. You see it. And this high is 45, 46.1. And this entire month of March candle, the body and the wick, all of it is inside the range of February. So in order for it to really be bullish, it would have to start to make a new high. It would have to take out this high. And until it does that, both sides can argue their point. But in the bigger picture, this thing is doomed. All right. Let's see. Let's take a look at what has happened since. Let's look at, say, the 23rd or 22nd of February, pretty much to now. The number one winner in that time period, believe it or not, has been Avis. Avis. And this foreign Chinese company has did pretty well too. But let me bring it had a double. Chinese e-commerce here. How do you pronounce it? Pinduoduo. I'm not familiar with it, but they did okay. Here's budget. We know ain't nobody renting no cars. Let's look at it. Oh, I want to see something here. I'm gonna come back to this page to show you why you can't believe the hype. If you're a technical trader, bar charts is a great chart to use. It's got a lot of screens on it that you would ordinarily have to pay for elsewhere. So this is the whole move from 545, but it's been falling since November. Okay, And so but it joined in the rally with everyone else. But it had a nice run from a low of around 141 to around $300, So you could have, gotten a double. Now it is possible that this thing could do one more swing and get up to here. Because this is an odd from an Elliott wave point of view, this is an odd looking structure. You know, given how long this thing ran up, we could get another swing up, and that would be a more common structure. But in terms of an ABC retrace, this is not. This run was too extended for that. So I wouldn't be surprised if we did get another pop, just to complete this, to make it look more typical of a wave structure. But the bottom line is, it does it's. Let me get to this peak four. We are overboard on it, so I'm gonna show you what the real issue is. Okay. Okay, put call ratio. That number is more than 0.8. So whenever it's more than 0.8, that means that's telling us that most of these purchases are short positions. Okay. Short positions, when you short a stock, it begins with you're borrowing the shares from your broker. So shorting a stock begins with actually purchasing it. Okay. It's like if I told you, instead of me asking you for a cup of sugar, it would be like if I asked you to buy me a bag of sugar, and I'll get it back. I'll give it back to you later. So you'd have to go to the store and get the sugar and give it to me. That's what shorting is. And then I bring it back to you. I bring the sugar back to you. Not now. If it costs you, let's say it costs you $5 or $2 to buy the bag of sugar, and you bring me the bag sugar, and then a month later, the sugar costs 35 cents. Well, I don't owe you $2. I owe you a bag of sugar. So I go and I I spend 35 cents and I buy a bag of sugar and I bring you back a bag of sugar. Okay. So it's kind of, it's sort of like that. And the depreciation of it, the difference in price from $2 to 35 cents, that's my profit. Right. It's not a great example, but it makes the point that you have to begin, in order to take a short position, you have to first, the broker is buying it on your behalf. So a short position begins with a purchase. So every rise up in a price is not an expression of optimism. And so that's the case with Avis, which was one of the leading stocks during this uptrend. I'm going to look at the S&P, the SPY, which is the ETF, which represents the S&P 500. And I think we're going to see the same thing. It's even worse. So the put call ratio is 2.37. So for every one in the options market, for every one call, a call is an expression of optimism. That means you're betting that it goes up. A put is pessimism, means that you're betting that it goes down. So for every call purchased, 2.37 puts were purchased. And so this rise is fake. Okay? It's fake. And what I just demonstrated to you is what technical analysis is. Okay? We look at the real, not the numbers of the company, not their sales figures. The stock itself is a commodity. The stock itself is subject to the laws of supply and demand. And there's chart related data that can reveal the real intention, the real sentiment behind the purchase. And this put call ratio is one to show you whether it's rising because people expect to hold it for the long term because they have an optimistic out view in the weeks to come versus if they're shorting it. And this market is being shorted. So every up move is not an expression of optimism. Now, I was going to hold that back and not get into that with y'all because I discussed that on my Patreon. If you want that kind of game and want to maintain this kind of focus and you want to go deeper and learn how to read these charts, join my Patreon. It's extremely affordable. Look below the video, click the link. That price is going to go up very soon. So you need to get in. I think that's enough for this video. I promise y'all a big, massive Elliott wave count, and I'm gonna get to that another day. Let me just say, let me look at the weekly on this S&P. Okay, and I will tell you this. This is the MACD, moving average convergence divergence. It shows momentum. Okay, meaning it's looking at the volume of transactions. Okay, transactional shares purchase. Okay, basically, is there an increasing amount of money coming into it as the price is rising, or is there a diminishing number of participants in the market as the price is rising? And this momentum indicator is showing us that there is or has been a waning participation rate over time. And the problem with that is when price when momentum wanes, let's say you got a nice trend going. I didn't mean to put that there, but this daggone magnet, blessing and a curse. The problem with waning momentum is when the price breaks the trend, there isn't a lot of people there to save it. Okay. And not to get too deep in Elliott wave theory, but that's one of the signs when you know that the trend is being exhausted. You see this divergence, meaning momentum moving one way and price going another. Now, of course, divergence can last a long time. So you don't just sell just because you see the divergence, but it does show a level of commitment or lack of commitment to that instrument. And it does suggest that if it starts to fall, you should be cautious that there may not be enough people to save it. And so we're here now looking at this S&P retesting this area here now. And that's the question. Is there enough momentum in this market? Is big money going to come back in to save it? And on the daily chart, we're already overbought. Overbought means that when we've reached these levels in the past, we would typically had a correction. That it means look for a correction soon. It doesn't mean look for a correction right now. It means soon, whatever that means. Okay. So we're already at a pretty risky level to be coming in on the bullish side. And so when you put all that together, we're at a previous high, which we haven't exceeded. And the theta, the data, the facts, not opinions, the facts, the technical facts that show that more than twice as many puts have been purchased recently than calls in this rally. Okay. And looking at the fact we're overbought on this status, and then on this daily chart, we've had like waning momentum for most of this run, which shows that the on the monthly chart. And you also see that we broke this trend line. So we broke the trend line, but we haven't been able to make like a key higher high. Put all that together with some other stuff that I can't, it's too deep to get in here because it requires you learning Elliott wave theory. This rally is fake. This rally is fake. Okay. I'll be back with a more exhaustive Elliott wave long range count of the Dow or S&P. I'm out. Peace.